Now don't make me sound like I'm like the lazy cousin who don't do research.
I mean,
that's part of my foremost strategy. So whenever I feel a little emotional, I go watch a show.
Hey, no shade. This is a safe space. You know, be who you are. It's a safe space.
My people.
Y'all ready? Let's go.
Yeah, it's about that time.
Where's Renz with our presentation?
Michael presented because my screen is so wide, it would show us so small. So
what happened to your books?
Is that your way of humble bragging that you have a really ultra wide monitor?
Yeah.
Well, I don't want to say it. I don't want to say that. You can say it.
Oh, this is like a come up presentation right here.
A little bit. All right, so this week we're going to be going over the last 3 weeks. Take a look at the interest rates and the correlation between the market. We're going to be reviewing, how y'all feel about the 50K milestone and, the mindset that comes with it. The shift between, I guess, a consumer to investor and ultimately to a future builder. We're also going to be talking about market manipulators versus market movers. So basically, moving straight into it. Last 3 weeks were rough. I know, looking at some of the comments, looking at some of the posts, it's really testing, who did their due diligence, who got into plays just because they heard it, and who really had a trading plan. But looking over the last 3 weeks, I guess some of the most notable things that we had going on was the weather incident that we had that hit the middle Americas, the rise and fall of crypto. Maybe I shouldn't say it like that, but the movement of crypto. In addition, we had a lot of news with the stimulus, and then we also had a little bit more information in regards to the markets as far as how it moved, turned around, and came back and picked up a couple more cuzels. All right, so looking here, first thing I want to cover is the weather. I'm really glad that a lot of our cousins out in Texas are doing better. They got power, they got water. They're back to where they need to be. But I find it kind of interesting that only 7 board members from the Texas ERCOT, the Electric Reliability Council of Texas, stepped down. Like, oh, I'm just gonna move my seat. No need to look here, no need to investigate. But yeah, that weather snap did a good job of highlighting a lot of the faults and the issues that they had in the grid there. In addition, it also showed a lot of weaknesses that we had logistically with getting products across. The already bad chip shortage that we had was even heightened more because of that. The weather did a bang up job of exposing a lot of weaknesses that a lot of people were hiding. So going forward, I would suggest that, if you're looking into a company, not only deep dive into their 10Ks and to where they're looking to invest their money, but also, fact check it, make sure that they doing what they say they're doing. You don't want to get caught like a lot of these companies here that resulted after this weather snap. Crypto was in the news a lot. Square was the first to buy large bulks of it. Then Elon with Tesla invested a good amount into Bitcoin. Oddly enough, during my research, I saw that there's somebody looking to sell 2 of their bars in New York City, Scruffy Duffy's and Hellcat Annie's. They're looking to sell them, and they're asking 25 Bitcoin for both or 800 Ethereum. The calculation, once you put that to dollars, comes out to about 1.4 million to 1.6 million, depending on where crypto is at the moment. But I found that interesting because now to look at people looking to sell real estate, especially large real estate such as that, that can't deny the fact that, crypto is starting to become more of a reality for us. It's starting to become more of what the community is looking to use as a norm. while the seller is still entertaining cash offers and all other kinds of offers, they said that their preference was crypto. Another highlight from the last 3 weeks, crypto went from a high of 57.4K down to 45.3K, which was 19.4% loss from its highs. Going into our stimulus, the 1.9 stim made it through the House. Now it has to go through the Senate. But in it has a lot of stuff that, I think will help the nation. One was the child tax credit. It's up 1K from last year's 2K. And if you have kids that are under 6, it's actually 3.6K. So I don't know about you, but if you're doing your taxes at 3.6, could definitely go for some contracts. Housing assistance, they actually had a lot in there. They had 30 billion for rental assistance, 10 billion for mortgage, and interestingly enough, they even put 5 billion to prevent the spread of COVID around homeless populations. I think that was dope. I don't think it's going to pass, but the 15K increase for $15 increase for minimum wage, I think that's going to get stopped out somewhere in between. It won't make it to the final checks. What else they got? The STEM check, the 1,400. The difference between this one and all the other ones, this one's actually going to be given out to everyone. So even adult dependents. So that means if you got your grandmoms, if you got older children that are above 17, they'll also qualify for it. So if you got a kid in college that you still claim as a dependent, you'll get another check for them as well. The unemployment, that's going to be extended out to the 29th. And also, there's $20 billion in there for creation of a national COVID vaccination program. So
Mike,
there's a lot of good stuff.
Mike, do you have a slide for the stuff that you're talking about? Because I still see the one with the boy.
Yeah, I was just recapping what we already seen already. I didn't put.
Oh, okay.
Yeah.
Okay, I didn't know if there was a slide with those bullet points.
No, I'm just going over my notes.
And just to jump in real quick, if anybody has anything they want to just add on, touch on that like I see Kevin has something else to add on, feel free to say so. Raise your hand. We want to have this more of a everybody kind of contributes to the conversation and just kind of everybody grows from this. So we just want to do a little something different this time. So just if you have any input, just join on in.
Yeah, I can pop in real quick to that comment I just put, if that's all right.
Yeah, go ahead.
Yeah, I was gonna say with the crypto point, in terms of transacting in crypto, it feels wild to me that by the time you sign the contract and the time the crypto hits your wallet, the valuation could be so different, but both parties are probably going to be okay with the transaction. It's like if it dips, somebody just bought on the cheap, and if it goes up, like you might have paid a little bit extra than you might have wanted to, but both parties, if they're hodlers or they actually agree with it, they're just going to expect Bitcoin or crypto to go up in the future anyway. So it's like you're not going to be angry once that transaction is done. Whereas I couldn't imagine that happening with US dollars. You know what I mean?
Yeah, that's a good point. But I guess that's part of the risk and reward with doing such a large transaction with Bitcoin.
I think we also still talking a little prematurely of how it will be when it's a little bit more settled. I think it's way too volatile for it to, of course, be used as in my opinion, to actually be used as currency. Just at this moment. D. Grant got something to say.
Yeah, I just wanted to ask if anyone a little bit about crypto because I'm still very green in that area, and I heard Mark when he was on the podcast for I think Nick Bogatz, if I'm probably butchering the last name, and he had brought up how corporations are possibly incorporating that, and he gave an example of someone selling a car and paying for it in crypto to a car dealership, and then avoiding capital gain. Avoiding the tax hit on that because it would just be counted as corporate revenue. And I just wanted to know if you guys heard that, and can someone speak a little lighter to it? Because I still wasn't quite following that.
actually a really good question. I personally don't have the answer, and that actually speaks a little bit to my question, which is how far can we really go with crypto or Bitcoin as an actual currency when there's so many people that don't understand it, and maybe I'm just not looking for the information deep, like maybe I'm not looking good enough, but I'm not seeing a large attempt of anyone to explain it to people or to make it more accessible to a larger population to where we feel more comfortable with it, with moving with it as an actual form of currency. So, I mean, I know that we have some cousins that are in here that actually do invest in crypto and possibly believe in it as a new form of currency. So I'd love to hear what you guys have to say about that. Lori, I see you have your hand raised. You should be able to unmute yourself right now.
Okay, hi, how are you? I did see that like Coinbase, what they're doing is they're offering you can earn money by watching videos to educate yourself by looking at their short videos that talk about the different cryptos that they're offering. And now you have like credit card companies that are also offering, oh, get $10 in Bitcoin if you refer a friend, or do this or do that. So they're offering incentives to get people to become more, I guess, accustomed to seeing the different types of the cryptos. And like when you go shopping, you'll get 3% back in Bitcoin that's added onto your account. And then what you would do is you would then transfer that for cash if you needed it at any point in time. So they're trying to get people more comfortable with transferring from paper dollars into the crypto dollars.
I was going to add on to the conversation about.
I was just going to say, I should have known to ask Lori if I really wanted to know.
Is there a way to?
Oh, sorry, go ahead. Sorry.
I'm sorry. I was just wanting to let you guys know if you wanted to know more about Bitcoin. I believe there's still online. You can research and read they have something called white paper, and it basically breaks down the whole concept of it.
Now, is that white paper on Bitcoin or is it on blockchain or is it a little bit of both?
I think they have it. I think they have one for Bitcoin. I can search in my I should have it on my computer, but if they do have one for Bitcoin, is that the white paper? Yeah.
Okay.
You can also find some videos on YouTube that also give you a brief breakdown. It's like the different platforms like Binance in their help sections, they tell you. Coinbase, they have in their help sections, and they have like little cartoonish videos to help anyone of different levels to understand them. You just do a Google search and you'll find it.
Thank you. What were you gonna say? I'm sorry. I know you got
I'm gonna drop this course into the chat. There's this one made by this. It was on a Clubhouse. This black developer. He made like a whole course into understanding like what blockchain technology is and how you make how you mine coins. So I was gonna post it in the chat. Also, I was gonna say like I think there's education out there. I just think it's a matter of like people finding the education, because I don't think there's like been any type of like I feel like everybody's been trying to educate. I just think it's a matter of like people finding that information actually to read, because like the white papers have been out there. Even ARK Invest put out a white paper on Bitcoin. There's courses like Lori mentioned, there's YouTube. There's all types of information out there. I just think it's that people just don't know it's there personally, as opposed to because actually for the education, like for instance for Bitcoin, the white papers is out there, but like there's no actual Bitcoin admin to really go out there to like actively try to that's responsible for trying to like actually educate. It's more so based on the masses to do it themselves.
Yeah. And that's why I said, I mean, I'm probably not looking hard enough for it. I'm the person, like, sometimes I turn on CNBC and I just need it to be like right there in my face, like, hey, here's the information. But to your point, And Mark says it all the time, like the information is out there. Sometimes we just have to go get it ourselves. So that's a very good point that a lot of you guys shed some light on just where a lot of that information is. I think Kevin wanted to add something else.
Just to pop in, thank you. From what I did see and looking up, there was I think it was a dude named Plan B who kind of ran some statistical analysis on it. And I think the buzzword you're going to hear right now, as opposed to currency, is going to be store of value, where they're trying to essentially peg Bitcoin as a sort of digital version of gold. And that, like, if you look at gold, I don't know if store is the right word, but the amount of gold we have today versus how long it takes to mine or create an equivalent value in the future in terms of like how many years that takes. I think gold is at like 50 to 60 years worth of production to get to where we are today. And that one of the big selling points for Bitcoin is that there's only ever going to be 21 million coins ever. So people are continuing to mine it. But when you contrast that with central banks, as you see right now, where they're just printing money left and right, you're not ever going to have to worry about that sort of inflationary issue with Bitcoin, is that you know what the max amount is going to be. And then another big thing that is, I guess, the Bitcoin community rests their hat on is this concept called halvings, where about every 4 years, roughly based on the production of how many Bitcoins are mined, going forward, you're only going to be able to ever mine half as much. So like, I think 2020, like May 2020 was the most recent halving. And then like several months down the line is when you eventually see the value of Bitcoin spike, just because it's that much harder to get more of it or get access to it. So like once you do multiples of 4 down the line, like 32 years, 40 years, whatever down the line, it's going to be that much more difficult to get more of it. And it's just going to kind of put a clamp down in terms of how much more Bitcoin hits the market. That's kind of where it is right now, where it's not stable as a currency yet, as someone had already mentioned. But if you try to look at it in terms of gold, in terms of how difficult it will be to get more of it, is where that scarcity and the precious nature of it kind of comes into play.
Oh, Lori, did you have something else to add? Go ahead.
Yeah. One other thing to watch out for, you'll probably start to see more news of like the billionaires stepping in, whether you have some that are siding with Elon, because Elon was the one that pushed the door open to allow for Square to step in and for the other businesses to say that they're accepting Bitcoin. But you'll start to see like Bill Gates, or you'll see Warren Buffett. They'll come in and they'll say, well, they don't see the value or the use of Bitcoin. What kind of use are we going to use Bitcoin for? And Bill Gates, he's coming in and he's saying, well, there's an economic factor or an environmental factor which is actually negative for the use of Bitcoin and for mining Bitcoin, because when we try to mine Bitcoin, Bitcoin is using a lot of resources, which is not good for our environment. So those are things that people would have to weigh. And if the public, is going to push back towards the feds to decide whether they want to move forward with it, or they're going to have to find a way to implement like what infrastructure, if they're going to switch over to crypto, what's a safer way in order to mine crypto, in order to allow for it to become mainstream and for everybody to use it, including the government and including corporation and the private industry.
Also, too, I think with cryptos in general, I think Kayla had alluded to it when she did her I forget which, I think it was Square, or one of those companies, the fintech companies that she mentioned. I think Ethereum is going to be the one that, in terms of use cases with the blockchain, I think Ethereum is going to be the one with the most efficient means of transferring funds. And I think with their 2.0, that I believe they were saying that they're going to implement like some sort of stopgap, where I think at this point it's just there's no cap on the amount of Ethereum coins that are in existence. But I think they're going to have a mechanism in place that would essentially perpetually destroy coins through future transactions, so that you're kind of almost approaching that level with Bitcoin where you got a soft or a hard cap in terms of how many coins are in circulation to kind of boost the valuation that it might have. So I think that's probably why those two are probably going to be the bigger crypto whales, I guess, when you look at all the coins that are available. But me, myself, I'm still pretty new in that area too. So there's a lot to learn with cryptos in general.
All right, so we're going to take just a couple more for this part of the discussion. Sharon, you've been unmuted. Go ahead and unmute yourself.
Thank you so much. I just wanted to let you guys know that to look out for Cardano, ADA, and read their white paper. They're in the top 3 spot as of today. So their platform is also built on off the Ethereum platform as well, blockchain. So check out Cardano, ADA. They're next to come up. They were as low as 2 cents, and now it's up to, I think, around $1.41. So just check them out.
Okay, thank you.
Okay, you're welcome.
And then Dave had a good question also that I'd like to kind of put out there, and we can see maybe who has some input on that. But Dave asked, what's the CO2 emissions and environmental impact of printing more dollars? I guess that's the question. I guess that's to speak to Lori's comments about just the impact of mining for crypto.
That conversation has been interesting to me. I don't know the impact of the mining printing dollars, but I know I've seen the report, I think it was from ARC actually, about the emissions from traditional banking versus Bitcoin, and it's basically saying like that's a fraction. Well, Bitcoin is a fraction of like what traditional banking entails as far as how much of a carbon footprint they make. Let's look to find that real quick.
Okay, Dave, you've been unmuted. You can unmute yourself if you want to speak more to your question.
Oh yes, thank you. Can you hear me now?
Yep.
All right. Yeah, so one thing that's been tossed out there a lot, I've been seeing a lot of negative press around Bitcoin, but all those arguments can be made about cash currency, about basically the infrastructure that supports the banking system overall. Think about just the amount of paper and that we use to just track and trail all this transactions. So I just think that you just be very careful of the narrative that's being pushed by the media regarding Bitcoin, because it just seems to be, you can make that same argument for basically a lot of different currency and just the financial industry overall. So that's all I wanted to point it out.
Thank you, Dave. All right, so that's obviously a hot topic, something we can definitely look into discussing in a future episode of Sentiment Saturday. We're gonna go ahead and move forward. I also wanted to just make a note that I see a lot of interesting resources and comments in the chat, and we are gonna do our best to collect all of those links and make sure that we post them along when we post the video. So be on the lookout for that. If there's people trying to catch them in the chat, we'll make sure we make those available to you guys. All right, so the next thing that we're going to talk about is interest rates and how they impact the market. So I know a lot of you guys saw when our friend Jerome came out and made some comments about the interest rates and just how his comments had an impact on the market and what you guys saw in your portfolio. So the good thing is he did come out and he did reassure everybody and say that, hey, you know what, I'm going to make sure that interest rates are going to stay low, and it should take more than 3 years for the interest rates to get any higher. He's going to make sure that they stay low, and that is a good thing for the stock market. So you notice when he came out and made those statements, a lot of the losses that you guys saw seem to kind of retreat and turn around, which was a good thing. I know we're still seeing some dips in the market, so unfortunately he can't fix everything, but we are relieved to hear that the interest rates are going to remain low for now. So why does that impact the market? What does that have to do with the stock market? So when interest rates are high, it basically makes it harder for everyone to borrow money. So when companies have a harder time borrowing money, that means they have a harder time. It costs them more money to do the things that they do. So if it costs them more money, that means they make lower profits. Lower profits means less money for us. It also makes money harder for consumers to borrow. So that means that consumers are spending less money, which again means that there are lower profits for businesses. And again, lower profits for businesses means lower stock for us. So all around, higher interest rates are not good for us. The only thing that higher interest rates do improve are just the rates for like treasury bonds. So if some of you are hedging your accounts with the treasury bonds, you guys are feeling really good right now because you should be seeing a nice little pop in the performance of those bonds. So I want to open it up and ask if there's any questions or any insights or input that any of the cousins want to add to that conversation, and we can continue on from there. Kevin just wrote like a chapter in the chat.
Yeah, I don't know. I'm very much quick to throw the chat than to speak, but I was in my head, to my understanding, when the interest rates go up, then the amount of interest rates the banks can charge or the financials can charge goes up, and that's directly affects a good amount of kind of their profit and the way they make their money too. So they're out here popping crystal when the interest rates goes up because they can charge more for rent on the money that either businesses or consumers are renting when they're borrowing against when they're borrowing in general. So I think that's why we've seen the cyclical turn to financials as everything opens up and market and the rates start to jump a little bit.
Yep. So to Kevin's point, there are some sectors that do better when interest rates are higher. So again, you will see like your financial institutions that are going to do better because obviously it costs more for us to borrow money, so they make more money. So yes, you want to rotate to those sectors like the financials that are going to actually do a little bit better during those times. Let's see, I think there was somebody else. And I'm not going to try to pronounce your name.
Sorry? I'm talking about, I don't even know if I said that right. I'm sorry if I butchered that.
Rates go high, you got to pivot to companies that aren't affected. Yep, good point. Anybody else want to speak to the interest rates, the Federal Reserve?
Hey, Vanessa, can I just add something?
Yeah, sure.
Hi, everybody. It's MJ. One way I like to think about it is like when interest rates go low, because bonds have a fixed percentage that they're earning, they become more attractive, right? So when bonds become more attractive, banks and things start to buy them more, which lifts prices. And then because prices are going up, yields go down, right? So the other way is like when interest rates go up, bonds get less attractive, right? So that in turn, lowers the price of bonds, which in turn raises the yield. So like there's a correlation between the bond yields and the interest rates. So if interest rates rise, we tend to see bond yields go up, which is like, a lot of times that can give us like insight into, inflation, right? So right now the market is kind of like pricing in inflation coming down the pipeline. So that's like one of the ways I like to think about it. Is like the reason the bond yields are going up is because bond prices are going down.
Well, to respond to that, wouldn't it, if the interest rates are going up, wouldn't that mean that the future bonds that are issued are more attractive than the old ones? And that's why you're seeing that inverse correlation. Like I got a 2% rate of return with this old bond, and now I know that the interest rate is at 3%. Why wouldn't I transfer my money to that new 3% bond? Like, I feel like with the rates going up, your return is going to go up if you ditch the old ones that are less valuable and jump into the new ones, correct? I'm not sure. That's the question I'm asking.
Hey, sorry, could you say that one more
MJ, did
time?
you want to respond to that?
Sorry, I was on mute. Could you say that one more time?
Yeah, so if the interest rates are going up, wouldn't that mean that future bonds that you can buy are more valuable than the old bonds at the lower interest rates? Or basically, like, you're getting paid more to park your money in the future instruments that have a higher interest rate than the old ones that are going to pay you back less for your money? Is that, I'm trying to figure out if the way you were looking at it is inverse, like if it's the chicken or the egg, like which way are we looking at it in terms of what might drive?
Well, the way I've looked at it and the way like that I've understood it is like, because you're earning a fixed rate on the bonds, so when interest rates go lower, the bonds become more attractive, right? When they get to a certain level, the bonds become more attractive, which would push bond prices up when people start buying them more, which then lowers yields, right? So when interest rates are low, bond yields typically go lower, right? And that's why we're seeing bond yields rise now, because people were worried about interest rates moving higher. Does that make sense?
Yeah, no, I appreciate that. Thank you.
And then David also, was it David? I think David asked about REITs and if they receive a boost during this time. My understanding is that real estate and like home builders and construction, those are also some of the markets that are less impacted by a rise in interest rates, because they use a lot of raw materials and the prices for raw materials remain stable even when the interest rates go up. So from that perspective, then yes, REITs would also be a safe place to kind of pivot into during a time like when interest rates are going to rise.
Side note, but you know, commodities prices been going up high, been going higher. FYI, like copper has, I think, gone up ridiculously high in the past few weeks, like much higher than normal. I think levels that weren't seen since like 2000, either 9 or 4. Hold on.
But hasn't copper been going up for a minute though? Copper's been going up for a while, I thought.
Yeah, but it's extremely high now. From what the last thing I seen, the prices reached an all-time high recently.
Do you know what that's related to? Because I never actually looked into it. I just remember hearing it a while ago, like a couple weeks ago.
I believe it's just due to like demand, you know, like between basically housing and like chips and sectors and everything in the EV.
So that's not necessarily, but so the copper demand though, that's not about the interest rate. So that's just
no. I'm just saying. I'm just talking about in general what raw materials as far as commodities. Commodities have been seeing an increase in price. And sorry, now I wasn't talking about the interest rate. Sorry.
Oh, okay. No, that's okay. That's okay. I was like, wait a minute, that doesn't sound right. But yeah, I know copper and lumber and a lot of the building materials are all going up. But I think that's more because people are buying more homes. Like they're moving out of the city because they don't have to go to work anymore. They're buying more houses.
Yep. So it's.
I'm sorry. Ake, you have been unmuted. Go ahead and unmute yourself.
Yeah, how you doing? So regarding the interest rates, they're not going anywhere because unemployment is not maximum employment, as Jerome Powell said he wants to do that. So maximum employment is getting back to 3.9%. It's not, everyone having a job. So let's be clear on that. And then that won't happen until approximately 2023. So now, since the rates are so low, we will see the U.S. dollar continue to become weaker against other currencies. And companies will continue to get cheap money. Now, whereas bad is that since the rates are so low, companies don't know what to do. They can't do anything with their cash. So that's why you see some buybacks. Because alternatives, if you look on balance sheets, you'll see where they'll buy bonds. Example, Square. They'll buy $1 billion bond, and then earn interest on that bond over the time, a year or two, or whenever the bond goes up for expiration. So since everything is so low now, you'll see them either borrow more money just to have cash on hand for the future when rates do go up.
Is a good point. Thank you, RK. And then Matthew, I know you said you wanted to add to the conversation. You've been unmuted. You can go ahead.
All right, thank you guys for having me. Question, do you believe that there could be some type of bubble effect that the feds are creating currently right now with continually giving stimulus to the economy? Because if you think about it, I was listening to something today, if you keep on stimulating the economy and you're giving the stimulus like the $1,400, you know what I mean, the $600 that they were previously giving, it's basically giving the money back to the government. And it's not really work that's been actually done in the economy, like as far as income. So if you take away, welfare and unemployment, Social Security, and the money that's been printed for those type of government attributions to the economy, then it gives a false perception of us actually stimulating the economy. So do you think that we're going to have like some type of bubble? And I was listening to something earlier today, and it was like, they're printing out this money and giving these bonds out for other people to buy the bonds, essentially. But when you're buying the bonds at such a low interest rate, they're not that attractive. And also, continuing throughout this economy, other bonds are maturing for people to collect. So it's like, are we essentially creating ourselves a bubble by keep on giving stimulus to the economy? Because bonds are continuing to mature, so people are going to collect on their money each month. But we don't have the money to provide to those other people. So essentially, are we continuing? I was thinking about something that it could potentially crash the dollar in a sense.
Quantitative easing has been a tool that's been used throughout history since the start of the Fed. Before it was always called a run on the banks, to where people would get scared, shook that their banks wouldn't have enough money to give them their money back. So the Fed was created so that it could create a way to ensure that we wouldn't have run on the banks. Quantitative easing is kind of a way to do that, to where they basically add more liquidity in the system to help float the books. You're right, to a point. Our national debt has been rising and it's not really been addressed. But it's kind of one of those things where it's been cooking the books for so long, it's part of the system. If we are creating a bubble, possibly, but it's one of those things where we have to address smartly on the long term. Not necessarily like big government's going to have to fix it, even though they created it, but ultimately it's going to be the puppets that's going to have to, kind of figure out a way to get us out of that.
Yeah, I mean, I was talking to someone today, and I believe that like increasing jobs and stimulating the economy, because people sitting at home, it's not going to stimulate the economy because we're essentially giving them money. You know what I mean? The taxpayers are basically essentially giving them money for us to give them back stimulus again. So it's creating that false effect, like the economy is in a better trend than we actually are, because we're really not, because of the job losses. And we're just basically giving people money that we've already put in their pockets from what we already been given. So that's why I'm just worried about. I'm just worried about the job losses, and people just need to get back to work so we can really try to stimulate the economy in a sense. Because if you take it, just the income of people actually working, it's actually lower than what actually the feds and stuff are reporting. That's what I'm saying. But that's all I wanted to say. Let's see if you guys thought about that.
Not to hop on Kathy Wood, but I was watching a video where she was feeling, she and ARK in general kind of felt that the bubble wasn't necessarily going to be with equities, but more so with bonds. I'm gonna have to try and find the video for that for sure and link that. But I feel like she was saying that it's kind of running pretty hot in terms of fixed income, in terms of the inflows to bonds, and that just the pent up demand just in general should be enough to buoy equities and kind of see them through, even though we're seeing a minor spike in terms of being overstimulated potentially with the stimulus, but that in the grand scheme of things, that the recovery to get back to some sort of normalcy should eventually outweigh any sort of fears of an equities bubble.
Okay. All right, I appreciate it. Thank you.
Also in response to that, we must understand this was a health crisis. This wasn't a financial crisis. So in order for the government, the Fed, to get us through this crisis, they need to print dollars. In regards to job loss, yes, a large majority of the jobs are going to be lost and not coming back because we've literally moved 5 years into the future, with remote work. And I personally believe stimulus is the alpha version of UBI, which is universal basic income. And I think that, yeah, you're right. A lot of people aren't working, but some people are working. And if it's the government that was like, we're stopping everything, so they got to foot the bill, Now, of course, we know inflation and our children's children is going to pay, on that bill, but retail, us spending dollars is, 77% of the economy, goods and services. So for them to say, yo, you got to stop, oh yeah, but frontline, you still got to work. And Amazon sales going through the roof, Apple sales going through the roof, people were still spending money, because unemployment is a part of stimulus. They may not call it that, but you're still getting money to sit home, because your job was taken away because the government said stop. So.
No, I do agree to that point, but I'm just saying for actual working dollars, because essentially what I was saying is that the government is printing money, right? We're getting the 1,400, but we're just putting that 1,400 back in instead of us taking away the government assistance that's been going on, and actually dollars earned is a different thing, because essentially we're working for those dollars and putting them back in the government, except for the government giving us the dollars. So we take away that and put in the working dollars, it's actually going to be, they're just basically trying to hyperinflate and giving us a false perception of us being a little bit better than what we are when we're not. And then the fact is that I'm afraid that in this whole type of bubble effect that they could potentially be doing currently right now is that it's like a balloon effect. You get a mortgage on a house as a balloon effect, right? So when you get the balloon on a house, a balloon mortgage on a house, when the feds are like the ones that's giving the money, right? So if they come collect, and as far as this increasing the interest rate, when we don't know what the interest rate could be in the future, let's just say they could increase it up to 10%. Those businesses are going to be like, what, 10%? Some of them ain't going to be able to pay the 10% interest rates that they've been dishing out and loaning out. So it's like it could potentially create like this bubble effect. That's why they could pull back the economy even more by giving the stimulus out. That's what I'm just worried about, what I'm thinking about.
Yeah, you definitely have a good valid point there. But to your point, like I said, quantitative easing has been a tool that the Fed has used for multiple years. It's something that they deployed. This is not the first time they've done it. Yes, in the long run, it will have to be paid, like Aki said. But ultimately, at this moment, that is, in my opinion, not the highest priority. The highest priority, like most of us feel, is getting the country back healthy, back into the normal move of things. But also in the interim, for us to get smarter with where we put our dollar. That's why the come up, I believe, is so important, because now we're losing the mindset of a consumer and gaining the mindset of an investor. We're understanding that the small changes we make today can help protect not only us, the culture, and our families in the future.
Okay, got you. No, I appreciate that.
So I got something to add. Okay, so with the rates going down.
Okay, excuse me, real quick. Right after Ake, Dave, you've been unmuted. You can unmute yourself. I know you've been waiting patiently, but go ahead, Ake.
All right, sorry, Dave.
No,
What I wanted to add was when the rates went down, right? Everyone's rates went down. So you know what ballooned from that? Mortgage refinances, right? So if I had a rate of 5 or 6%, now I'm getting a 2.7. That extra cash flow, guess where it's going? To buy goods and services. So it's a byproduct of the rates going down so low that the Fed, unlocked trillions of dollars that people are ready to spend. Not to mention when everything opens back up, that's more money for them to spend on the economy, because us spending dollars benefits the government. And
okay.
And then Fed is the credit house, right? So one man's credit is someone else's income. See what I'm saying? So the 1.9 we about to borrow is about to get sent out to everyone. That's now income. That's not being taxed, right?
Okay, so, let me ask you one question though. So let's just say the old bonds that have already been given out, right? They mature. Let's say $3 trillion have matured, right? So $3 trillion have matured. That means that they have to come up with that $3 trillion. So what the feds are going to potentially do is they're going to increase the rates because they have to get that money to pay the lenders that borrowed that or they took on those bonds, right? So let's just say somehow, let's say in 2 years, right, $3 trillion worth of bonds matured, right? So people are going to come collect. So the feds are going to have to increase the rate regardless. They can increase the rate tomorrow if they really wanted to. They can say, forget everything. We have these bonds that are maturing. We have to pay people. They're going to increase the rates. So if they can get money back to give back to the people that borrowed initially 10 years ago, you know what I mean? That's what I'm worried about. That's what I was just thinking about. I do agree with you in the sense that, yeah, it does stimulate the economy and it gives that, I guess, superficial illusion that everything is okay within the surface of the economy. But I'm trying to think of like deeper within the Fed economy and how they're moving that money, because they have people like China and stuff like that are taking on these maturities of these bonds and they're gonna have to collect. So if $3 trillion worth of bonds come out that they gotta pay them bonds, and they're gonna have to increase their rates in order to do it. That's what I'm saying.
Hey, Matt and Akia, I think that's some really valid point there, and something that I've been thinking about a lot is this whole false pretense that we have that how the economy is doing. But one real good way to measure the economy, and it's something I found very odd, is that Goldman Sachs actually raised the GDP forecast for this year for the US. So when you look at it, I think they had it from a 6.6% and they raised it to 6.8. So that GDP, I don't care what this whole interest conversation, that's really what the output of the country. That really shows you the state of the economy overall. So now the question is, why would they do that if we have all this hoopla around raising interest rate?
Productivity.
Yep.
Everybody believes productivity is going to increase tremendously. We short, think about it, we short in COVID in a matter of, if we jump 5 years into the future, that means we hire all these costs of interest rate. Anything that will happen is going to be offset through the cost of like how much more productivity we produce in our products and services. If we become more efficient, then the cost of goods and services go down and we produce more stuff for the consumers, right? So
exactly.
you don't have to really worry about interest rates in the long run.
Exactly, that's the point I'm getting at. Ultimately, it doesn't matter. I mean, and that's the reason why these tech companies, like the tech sector, is getting hit on this whole rising interest rate. But the one thing that this tech sector actually does is increase productivity. So that all that innovation, that disruptive innovation that Kathy Wood talks about, offsets that. So ultimately, it shouldn't be a concern if you're looking at the long run, because they will continue innovating, continue raising the GDP of this country through technologies like robotic, biotech, less sick people, less trial and error trying to get a new vaccine and drug out there. I mean, all that time can be used to be more productive, and the country
Yeah.
will be more productive in that way. So I just want to throw that out there, kind of just to get people to think.
No, that's
Standpoint.
exactly productivity. I 100% agree. I didn't check out that GDP though, but yeah.
Yeah, take a look at
Nice.
Goldman Sachs. They came out with a report recently regarding the GDP for the country this year and next year, and it's out
It's
there.
ridiculous. Okay.
Yeah.
Oh, nice. Okay.
All right. Thanks, guys.
I appreciate it.
All right, to piggyback off that, let's fast forward 36 months, right? Robo taxis is everywhere, and now you get anywhere for $5 to $10, and I'm talking about anywhere. Like a 100-mile trip costs you $20, and that's just tech, So now, if your income, bring home was $1,200 a week or every 2 weeks, right? And your cost of living went down because you refinanced your mortgage, and now you don't need a car anymore because the the lease cost, you don't need it because you could just use a robo taxi. Now you just freed up cash flow, right? And then if vertical farming starts becoming more of a thing, now cost of food is way low, So it's like, this is just hypothetical. If tech comes in and literally brings down the cost of goods on everything, like life, then everyone benefits. It's just one of my theses.
Right's law.
Miss Lori, what were you gonna say?
Well, the other thing that we have to remember is take a look at the companies that the feds are pouring money into, because in our last presidency, there were a group of companies that that Trump poured money behind, and then what happened was the companies that didn't meet certain standards went into the treasury bonds or went into the debt notes. And then now you see, like in this presidency, there's another group of companies that are coming out, where you have like Biden is putting out Walmart, he's putting out Target, he's putting out a lot of the consumer discretionary companies. But the way that I see it is that when the interest rates are low, it causes all those that were pretty much left behind to catch up. So he's kind of putting a pause on the tech companies, because the tech companies are moving so fast that all the other companies are having a hard time with catching up. So this is their time to catch up. And then you get the tech companies will come back in, and then everybody will probably pretty much be on the same pace, or will continue to grow together. So this is like a temporary pause. Like it's the same thing in Europe. What they did was that in order to, after a crisis, in order for them to get the value of their currency back on par, they had to reduce down to negative interest rates. But this is something that the United States would not do, because then that would cause the banking industry and the financial industry in order to, to fall and to suffer. So we'll go as close to zero as possible, but we'll still allow for productivity to increase at a slow pace, but not increase it too fast so that we can cause the bubble to burst. And I mean, it's up at play on the Fed side, but you pretty much see like the Feds are backing the companies that that they feel that would push that productivity forward, but at the same time they're making sure that there's a balance in between. Those that are not working also provide resources for them so that they're not falling behind as well.
Excellent insight, Lori. Thank you. So it looks like we're going to move the conversation ahead. We did have a section where we were going to talk about the 50K milestone for the Come Up series, but I think we're going to jump ahead and talk about market manipulation versus market movers. I think this is a very timely and important conversation to have. So just given the time of the evening, we're going to jump to that part of the conversation, and maybe we'll backtrack to the 50K milestone, but right now we're going to switch it to Tayo so he can talk about market manipulators versus market movers.
All right, so when we think about market manipulation, I kind of think about what's going on right now. If y'all was on the Clubhouse earlier today, ironically, we was talking about interest rates and as far as what do we think the market makers are doing. And in my opinion, I believe there's a lot of manipulation. I think there's a lot of rotation as to taking money out and putting it into different sectors. And all this is just because they want to buy who we call in the come up the winners at really good prices. They are trying to shake out people. They want to shake out. So you have a lot of money. Like when we think about manipulation, let's just think about it. So you have pump and dump, right? Which is like kind of related to like fake news or any type of news that come out. And if you think about pump and dump, this is when you think of a stock. Just pick a stock in the mind where you just thought of some news, and then you just see it the next day jump up like 98%, and a lot of that is your pumps and dumps. And that just goes from, certain situations can arise where retail traders see this, they hop on board because they're excited from this enthusiasm. They get hyped with greed and they get in and they get in on the ride. And as soon as they get in, price drops. That's your pump and dump. And they work on your manipulation as far as preying on our emotions as retail traders. That's why a lot of it is about sticking to the script, being disciplined in motion, because they know how a lot of us are going to react when we see so many people just, oh man, they're making lots of money. We jump on board and they're using the manipulation of our emotions to basically manipulate us to get our capital, our capital for their liquidity. There's also another form of market manipulation, but we don't tend to look at that as much. I don't think a lot of people are using like level 2 data, but it's usually where you will see like a large player place trades for like a large amount, and then as soon as the trade is about to happen, they exit the trade. I mean, they cancel the trade, so it doesn't actually go into effect. But that's something for like level 2 data. And when we think about market movers, those are your whales, those are the institutions, your smart money. When you have, when you think about the algorithmic trading, when you think about your Buffetts, your Cathys, your ARK Invest, these are the people who are basically provide liquidity. They provide the liquidity to the market, and that's basically what moves the market. They are also the people sometimes who are also the people also that are also the manipulators of the market. But also understanding that there are also times where the manipulation isn't, there is a manipulation, and that's just basically being able to decipher if the market is moving because of actual fundamental catalyst news into the market, and being able to decipher through the news and being able to decipher, okay, the market is moving according to fundamentals instead of BS, basically.
All right, so I'm seeing a lot of interaction in the chat. It sounds like there's definitely some comments that need to be made surrounding this topic. First person to raise their hand, I see cousin Kevin. Kevin, you've been unmuted. Go ahead and unmute yourself.
Yeah, I feel like to jump into this conversation, what's the where you draw the line? Like, if you're moving the market, technically you're manipulating it. Is it just that the manipulators in this case are the ones that are doing it through nefarious means, and that's why we're looking down on it? Like, if you got a bunch of hedge funds that are kind of meeting at lunch to talk about how they're going to move the markets, like what's the difference between that? What's the difference between that versus if you just got a bunch of people on a forum saying, hey, let's go ahead and pump this stock up because we quote unquote like it. And then I was saying that I felt like GME was a great example of both sides of this, because you see the retail traders that are doing what I guess might have been historically done behind closed doors, and then you see the strong adverse reaction from CNBC and from some of the institutional money kind of saying this can't happen, this isn't good, but at the same time they're still riding the wave up and down and up again. So it's like, what's the real dividing line between manipulators versus movers?
Well, there's a few lines, right? Well, like one line for sure is that if you own 10% of a company, you have to declare it. You just can't go around talking to people about your trades. So that's one line. And we're in a room and I own 10%, I can't just be talking about, I'm gonna buy more shares or sell my shares of the company. Can't do that. Another thing is, if it's just us, I mean, capital makes a difference too, I think. And if we have a certain amount of capital, a large amount of capital, I would say more than likely we probably have our money with hedge funds or investment, and they have rules that they have to abide by. As far as what determines if it's right for, well, if you're a hedge fund, you can't talk about your trades in forums in general. You can't do that. So that's the line drawn for there too as well. So for like you, because you have your Series 7 or Series 65 or whatever, you can't talk about your trades to the public without at least a disclaimer and everything. What lines you have? Is there any? Does that make? I guess does that kind of make things clear, or?
Yeah, I was definitely a bit baited in the favor of the Wall Street bet. I mean, they were still very reckless, but it's not being in that room, in quote unquote the room. It's kind of real easy to be suspicious of kind of the institutional or the establishment in terms of just how they operate and what they get done. So it's definitely eye-opening, I'd say. I mean, it's one thing to know that you can't do it. I'm sure there are those who do it, but I appreciate the insight for sure.
Now, I will say the one thing I'm not sure about is if, like, okay, so let's say we never established a hedge fund or anything of that nature, but we just all got millions of dollars and we're in the room talking about buying shares. I don't know. Now, that's the part I don't know, because we don't have a financial license. We don't have no series. We don't have none of that. And we're just friends that happen to have lots of capital. What happens then? That's the question that I don't know what makes that different. I don't know how that will work as far as yeah.
Lori said the whole story is not being told. What's the whole story, Lori?
I don't know the whole story, but to me, it's like all of these trades where you see like the pump and dumps, they're saying that the SEC pretty much put a pause on the market to monitor like where these pump and dumps are taking place. They're watching when the market opens and they're watching when the market closes, because they know that's the most volatility that shows up in the market. But when you look at extended trading hours, that's when you see those moves, which are like 1,000 points from the last entry. Are you gonna blame it on Robo, or are you gonna blame it on the hedge fund that has these things that are going on? We know 2 o'clock in the morning it's not retailers, so why you keep saying that it's retailers? If a trade is going on at 7 o'clock at night, 8 o'clock at night, it's not a retailer. We can't even touch our platforms. So why are you placing the narrative on the retailers when the retailers don't have enough money to throw these trades into the market and to bankrupt GME, AMC, or a bunch of the other ones that are on Wall Street bets?
That is a very good point. And I personally also agree that I know the narrative is, oh, it's the little man versus big money, but actually that's not the truth, because we all know that retail investors don't have the juice to move the market and to impact the GameStop stock the way that it was moved in the market. But I see a comment in the chat that I want to give voice to, because I'm curious to see what you guys think. But I'm still not going to try to pronounce your name. he said, he or she, because I don't know, said everyone who bought that XLY the day after, you guys know the play that shall not be named. Everyone that bought the XLY the day after is no different than GME action, even though GME jumped out the gym. So, what do you guys think about that?
But GME jumped up how much percent in one day? that we didn't do that. We didn't. That's a difference. Like that couldn't have been just retail traders. That was retail and hedge funds and investment bankers, smart. But like that was institutional traders versus institutional traders that was masquerading as retail traders.
Right.
In my opinion,
I think what they were trying to add in there was that, you know, it was basically a move that was orchestrated. But yes, it's a difference between taking a coordinated jump than per se saying having a whale come and swim up across a beach and make a tidal wave pull onto the shores. You can't compare the two. You just can't.
So, like, even the unusual options activity, yeah, that was one thing, but like the actual GME, it was unusual options activity for almost every. Like, it was like multiple strikes, and it was 120% like shorted. Like that was ridiculous. The amount of shares you needed for that, the amount of options that were being bought, all of that was ridiculous. I mean, you could have bought a put, price was going up because the volatility was so high that you still made money on your put, even though the stock price was going up.
That's facts, because I saw it. And
I did it. I did it, so I know it happened. It jumped up. GameStop jumped up still like another $30, and my put still went up 200%.
A friend of a friend told me that happened to them too. They were very they were very confused. Ake, you've been unmuted. Go ahead and unmute yourself.
Okay, so what happens year 4 when our combined movement is in the trillions? You know, we all like, yeah, we're gonna go in this position here, or
Yes,
you know,
sir. Yes, sir.
You said year 4?
or year 6. I mean, like,
it's not gonna take that
long. We're just not there yet.
I'm just saying, like, well, we gonna get a letter from the SEC.
But I mean, that's what I said. I said I don't know what that means, because we're not a hedge. If we don't have a hedge fund, then what do that mean?
Would like to think that because our group is private, we're not as flagrant as Wall Street bets, so they might not know. Not to say that I'm saying that we need to be doing that type of stuff, but I feel like it'll be a little bit different.
Listen, I'm gonna need Rick Castro 213. Don't be putting that in the universe. We're not going to jail. Don't say that. What? Don't put that out there. That's not cool. Rick said we're going to jail. We're not going to jail.
I mean, we also might, you know, hit contract limits. Oh. You know, I think a contract limit is like 250,000 contracts. You know, by year 10, 12, you know, we may be hitting those limits. So we may have to start doing.
That's a good problem to have, though.
Yeah, you're right. It is, but I mean, it comes down to like, how do we start making our money work for us? We might have to start doing dark pools or something like that, because we're gonna be bigger than BlackRock. So I'm just like,
when we get there, though, I feel like we'll become an institution, though.
Yeah, you pivot into another instrument. That's why they have the futures market, or you pivot into SPACs, or you pivot in, you then become an accredited investor, so you have other instruments that you can put your money into.
Facts. Everything. Because I'm definitely going to start doing investments in private companies for sure. I'm trying to get in there before they get public.
I think I read that there was something that concerned the Fed, how they see that a lot of the public money is going into private projects where they can't control what's going on the private side, which is a concern to them. That's why the stock market's not moving that much, because a lot of money is shifting, and then you have a lot of money which is going towards crypto, and you can't follow what's going on in the crypto space. And that's why that's that concern for them. because private money, they're doing like a lot of, like their own blocks, their own white papers, and their own stuff that they're investing in projects that there's no control over, and then the regulators are sleeping. They haven't caught up to like putting regulations in place in order to say, okay, this is what you could do, this is what you can't do. And once again, Elon, he's the one that's like opening that door to allow that to happen. And you might see they might come back after him and say, because of his tweets on Twitter and his tweets about Dogecoin, he may be the one that they may try to penalize in order to get that regulation process started.
Great point, great point. And that's also a good way for us to segue into the 50K milestone.
Mike.
Can I jump in just 2 seconds?
Yeah, I was gonna say real quick, Cousin Faye needs to say something.
I just wanted to bring up two points. First of all, the XLY play, the correlation that was attempted to be made, I think is there's some fallacies in that. And the biggest fallacy and the takeaway that I have is the background, the underlying fundamentals of a XLY play pertaining to the top 10 holdings versus the actual GameStop. That's a big takeaway that I think automatically just separates the two, right? And the second thing is I don't want the illusion that we are not being watched, because we understand through evidence of things that came out prior to what's going on right now, that they are watching Mark, they're watching the Come Up series, they're regurgitating some of the statements that are, or the flavor that is given through the Come Up series. So I don't think we can downplay ourselves to say that they're not watching, because they are, and there's evidence to support that. And then, I'm sorry, I said 2, but I'm gonna say 3. And the last takeaway I would like to have, or to strengthen what I just said, I'll say it that way, is because I was interested when they did what they did to GameStop. They did it again last week with a couple of unknown stocks. And so, and what the article, and I don't have it right here, so I apologize to not be ready, but one of the takeaways from the article that I did read that indicated that they did do it again to several other stocks. They listed the stocks in that particular article, was that they were scanning screensavers, like we scan for stocks. They scan media platforms. They have analysts actually going into the field scanning to get information so that they can make that determination of, hey, listen, there's too much activity, too much profit being made in the stock in conjunction with additional plays that may be given. So they are, if you look at all platforms, maybe not enclosed, even though we do have some loving cousins, we got some other cousins that maybe even our group is telling things that are being said, things that's coming out. But if you look at the Instagram, the Facebook, the YouTube channel, there are other platforms that we give information away that they're able to decipher what's potentially our next play as well. And they're looking with the Robinhood situation. One of the things that I took away from that is it was said that on the back end, whatever we are doing in the option market, put option, doesn't matter. They are basically selling that information to outside sources that could then play against us and hedge themselves against our calls, for example. So a lot of information is being given that I think we need to be mindful of as we move. And the key takeaway for all of this that happened the last 2 weeks is Mark has given us a blessing to educate us and be matter of fact about it with Jolene, to put ourselves in quality companies. Once again, going back to the fundamental research that we all should be doing, our own independent DDs. I talked about it earlier, as you know, Vanessa, on the Clubhouse today. We've got to be able to stand by, this is what I have seen. I love Mark, I love Jolene, I love Vanessa, Teo, did I say it right?
Tayo.
Oh my God. My son even told me Tayo the friendly the bus. But anyway, I'm sorry. Tayo, sorry. I love you all, but this is my money and my husband's money. And so we have to be mindful of, it is our responsibility to build first of all, to make sure that we walk away as a set an example for those that maybe either our children or who are definitely watching us, right? And as a collective, we have to be able to give back. And the only way we can give back and continue to move this dialogue further is to have a true awareness of why are we doing the things that we're doing. And I can say to Vanessa, I disagree. And this is why I can do a reference and tell you and let you see what articles I've read, where am I getting this information for? It's not just because Mark said or Joe Lynn said, or because it came on the Come Up series timeline. The plays that Mark just gave out, I was already in those plays. So, I mean, it's like we have to be, that's what he needs us to do. And that's what we have to do for ourselves and for those people who love us and are depending on us to show up and show out. So I'll take away. Sorry, guys.
No, I'm so glad that I'm so glad you got a chance to speak, because that is the perfect segue into the next conversation. And yes, we did talk about that on perfect segue, right? And we did talk about that on Clubhouse, and it also kind of speaks to what you were talking about, Tayo, and the way that we avoid being swayed by market manipulation is by doing our own due diligence, by not just following behind people, by understanding and knowing why we are getting into plays. Because when we have that information, then it doesn't matter if the market makers are trying to shake us out of our position so they can get them cheaper. We can stand still and hold our spot because we know that we're in good positions, because we've done that due diligence and that research. So now, with that being said, we can segue into the next conversation, which is the Come Up Series 50K milestone. And this is where we're just going to talk about, like Mike said, just the difference between moving from being a consumer into being an investor, and what that means for you, what your responsibility is as a cousin, as an investor, and as a part of this journey. So I am going to I actually don't know who's speaking to that part, but whoever is speaking to it, go ahead.
Oh, well, I didn't. Who put this up? New investor. I posted the article.
So cousin AJ was gonna bless us with the mindset change, but unfortunately she had something that popped up and they did get addressed. So I'm gonna do my best to fill in. Now, it's good to look at the good part of the 50K. We got everybody in, we got everybody watching, we got everybody following, doing their due diligence, like Faye just mentioned. You got to step up and be better. You can't be a cousin and be lazy at the same time. You got to do your homework. But one thing I think that was important that I saw was this graphic right here. It shows pretty much who's been investing, who's experienced and trying to get into the market, and then also relatively new investors. If you can see, all of us that fall into the minority group, we don't got good representation, and I think that was a big thing in regards to the spreadsheet that Mark shared. If you looked at the numbers, it wasn't a lot working capital to get started. It was 2,500 based across everybody's in the Come Up series, and ultimately, as all of us working together, we can, within time, match the GDP of the entire country. So that's one daunting task, but I think it needed to be also seen that we can do it from such a small platform. If we all work together, we all do our homework, we all do, like Faye said, and do your homework, go find your entries, go find your plays. Don't wait for somebody to yell out a play on Clubhouse, find that mindset to be hungry to go and look for your reparations in the market. We can make this chart change over time to where we have more of a representation and also impact our communities a little bit better.
So let me ask, Mike, is this accurate?
Yes.
Is it really only 17% of new investors?
Well, look at the bottom. It does say 1,291 U.S. adults were surveyed between October 26th and November 13th.
Okay, so maybe it's not a good population size. Maybe.
I wouldn't be surprised if the real data maybe might not be that off either, but I mean, I do think a lot of people did jump into the market though, I think for the first time. I mean, I saw a lot of people.
Hey, that's why I'm kind of giving these numbers the side eye. Like, I don't know how accurate this can be. I mean, we have 50,000 cousins. Yeah. They didn't ask the cousins. They couldn't have talked to the cousins. You're right, Renzo. They didn't talk to the cousins. That's the problem.
We were smart. We were home quarantined.
Well, if they
we were in quarantine.
see, they should have surveyed. They should have surveyed in the summertime. They probably would have caught a lot more. But
Right. So everybody in here is part of this this 50K milestone. So we'd love to hear what you guys think about the milestone and where we go from here. Kevin, you've been unmuted. Go ahead and unmute yourself.
I want to say there's been several times. Like my brother, he's also in the group. He's Wainwright Wentz. He tried to put me on around October, November. I didn't give him the time of day, and then kind of hit me with an impassioned email, and I gave it a look, and here we are. But I feel like there's been several times between, I want to say, the Roaring 20s video and then the most recent video on Tuesday after we hit that milestone. Like, I know Mike had just mentioned it, how that was just $2,500, but I feel like I'm gonna say it again because I don't know if people are understanding. Like, that wasn't even a rolling forward. That was just one. Like, that was one-time contribution, and you had the potential to do those numbers in 5 or 6 years. Like, this is on another level. Like, if you would have told me that I could have potentially have the option, no pun intended, like it's available to me to walk away from my job by 2023. If you weren't talking about the lottery, I would have told you to kick rocks barefoot. Like, this is different. This is different, and it's just it doesn't make sense. It does make sense because we're learning how to swim. We're learning how to think like wolves. We're learning how to see blood in the water. Like, the amount of people that I've seen in the last few days, in the last few weeks, excited the market was red is different. I got friends that are talking about, like, oh man, my stocks are down today. I'm like, well, did you wake up and turn on CNBC? Futures were negative just before the market opened. Like, you didn't see that? Like, certain little other things, like, oh, well, did you tell me what was going on with interest rates? You, like, just other things, and it's not to be like an elitist or anything. Like, it's just like there's so many things that we as retail traders are not taught, so many things that we don't know where to look for, where it's just like, I started learning about this stuff in December, and I feel like I'm very well on my way to being unfuckwittable, and I see 50,000 other people in this group that are on that path as well. Like, it's, I don't know, it's different. That's the best way I can put it, is that it's different, and I appreciate each and every one of you because you bring your own flavor, you bring your own due diligence, you bring your own